Good afternoon, everyone. Thank you for joining us today. We hope you are doing well and staying safe. My name is Maria Asher, and I'm part of the investments team that manages the Westwood Select strategy. We wanted to take this opportunity to discuss our outlook for the energy sector and the impact of the recent decline in oil prices. For that, we have Leah Bennett and Bill Costello joining us on the call today as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on the Select strategy. Bill is a senior vice president and a senior portfolio manager for our small cap value strategies. He's also the lead analyst on the energy sector. With that, I'll hand it over to Bill, who will share his outlook for the energy sector. Hi, Bill.
Hi, Maria. Thank you very much for the introduction. Uh, I'll give a few highlights of what we see in the energy market at this point in time. Obviously, it's been a very challenging space to invest in and very challenging for the industry itself, as we've had really, I would call it a double black swan event with both the supply side of the equation giving the market difficulty and the demand side, obviously, given the COVID-19 issues. Typically, the times we've had declines in oil prices, and we've had obviously large declines before, it's been exacerbated by one of those issues, but not both simultaneously. Typically, it's a supply shock, like in the 2014 to 16 timeframe when Saudi Arabia increased their production to somewhat flood the market, or it's the demand side of the equation. If you look back to the depression that we had in the 2008, 2009 timeframe, but typically it's been either or. But at this point in time, we obviously have both working in tandem. As we started this year, we were a little concerned that this would be a difficult year for the oil markets just because of the supply situation. There was some supply coming online that was maybe one time in nature, a couple 100,000 barrels in Brazil, a couple 100,000 barrels in the North Sea, a couple 100,000 in Guyana, which, each one individually isn't all that much, but if you add them together, it's close to 0.6% on the supply picture. At the same time, the U.S. shale revolution was hitting its stride, and we were up over 1 million barrels a day year over year on supply. So as we were going into the OPEC meeting in March, we thought OPEC would continue the supply reductions that they had been doing over the past few years. Ever since they really shifted their strategy after the 2016 price collapse, or 2015-16 price collapse, and we were very surprised that OPEC couldn't come to a commitment at that point in time. So Saudi Arabia decided unilaterally to push another 3 million barrels a day out into the marketplace, and that coincided with the demand picture rolling over. As first it was China with their shutdown, and Chinese demand was down at least 30-40% for oil in a relatively short period of time. And then obviously, as this terrible virus has spread through the globe, the US, which is the largest consumer of oil in the world, is feeling the pains of it now. Europe, who's probably the number 2 consumer of oil, if you aggregate all the European countries, they use a little bit more than China, probably 15 million barrels a day, where China is somewhere around 12 or 13. And obviously, as all those countries have gone into lockdown, that has certainly hurt the demand in those countries. And obviously, with air travel being limited, besides hurting the airlines, certainly it's also jet fuel is a big part of the consumption that we use oil to make. And all those things hit at once, which has caused the anomaly in the oil price and the collapse of it. We see some green shoots, some hopes of light in the future. You've got OPEC Plus coming together and cutting supply. They're cutting May 1st. Most of them have already taken into account and done it a few days earlier. You've got the US production, which is going to be flattening and rolling over as the US is shutting in wells and curtailing unprofitable um, drilling activities. Because obviously, as you can imagine, if we look at the screen and see a $15 oil price, um, we've made great strides in the US industry in lowering our cost basis and our break evens, but there's really no wells in America that are profitable at $15 oil. Um, so you will see that play through the numbers, but realistically, it's not something you can turn on and off like a light switch. So you won't see the full effect of that till probably the fourth quarter of this year, and certainly rolling through to next year. You've also seen some signs that demand is coming back slightly. You've got China returning more to normal, and their demand is rebounding like you would expect. You've got some hopes that the US is actually going to open up for business. Um, some states as early as this Friday, and certainly by June 1st, if, hopefully we've contained this virus, we will be somewhat back to normal. And that demand coming back in the market, along with the supply being taken off the market, will come a little bit closer to balancing the market. If you think about it right now, and there's not many good statistics out there, but if you take at face value the supply coming down by 10 to 12 million barrels a day, that's a huge number. That it's on 100 million market basically. But the fact is, the global demand is probably down 20 to 25% right now, and until that demand starts coming back, it'll be very difficult to balance the market. So, in the near term, there's certainly a supply imbalance, and as we go through the rest of the year, that will normalize. The question is obviously when, because we really don't know the depth of the demand destruction, nor do we really know what the magnitude will be. And when the world gets back to a normal environment, or maybe in this case, a new normal that's different from what we knew before. So that's really sums up the overall picture. It's going to be difficult for oil prices to rebound in the short term, but we do think by fourth quarter we'll be coming back to a more normalized level, and the companies that are strong enough to survive in this market should face a much better outlook in 2021 and 2022, because the seeds that we've sown of the supply destruction will linger for the next couple of years. And if demand rebounds to any kind of normal level that it's had over the last 15 years, that will make for much tighter markets.
Thank you so much for sharing your comments, Bill. We really appreciate you being here. You've got such a great history with the sector, and I wanted to ask a few questions that we hear quite a bit from clients. Before asking those, I did want to kind of give some insight into how our strategies, our investment strategies, are positioned as it relates to energy. And across all of our investment strategies, we're either underweight or equal weight the energy sector at this point in time. And so basically, what does that mean if I say that we're underweight or equal weight the sector? So there's been so much value destruction within the energy stocks. Energy now represents less than 3% of the S&P 500. So to put that into context, Apple alone represents 4%. So Apple has a larger market cap than the combined total of all publicly traded energy companies. So just like I said, the value destruction has been really significant. Getting into questions, energy is certainly very important to the state of Texas. If you look at 2019, Texas accounted for 41% of all crude production and 25% of all marketed natural gas production. So I'm kind of curious, given what we've seen happen in energy, what are your thoughts as it relates to the impact on the state?
Oh, sure. I mean, I'll give you some high level thoughts. I mean, obviously the impact is going to be dramatic and it's going to be painful for many of the participants, and there's going to be a lot of collateral damage. I mean, if you look at the companies, there's definitely going to be layoffs. We haven't seen as many announcements yet as I would have thought. That certainly affects the direct players in the industry. There's also the supplier base that supplies into the industry, and they will obviously be affected in the same vein. We've also seen some, or recently we've seen announcements for most of the companies at the executive level down to senior management, where they've all been taking pay cuts to try to ensure survival for this year. And they've all been in the neighborhood of like 20 to 50% of basic salaries. So if you think of that flowing through the Texas economy with executives or with anybody within the oil industry having less money to spend, you can imagine that hurts restaurants, retail. It just is kind of a ripple effect through the whole economy. So it will be a difficult time. I will say if there was a silver lining to that picture, there might be two of them that I could think of. One would be to your point about the gas that's produced in Texas. As we drill less oil and our oil production comes down, the associated gas that comes with that oil production will also decline, which will basically be good for natural gas prices, which have been depressed for many years. There's a possibility that they might be a little bit more attractive than oil prices at this point in time, with the outlook over the next 6 months, let's say. The other thing I would also say is with the lower oil prices, that really translates directly into lower gasoline prices. And to the degree that we ever get back in our cars and drive again, we should all be happy to see the prices at the pump.
I think that's a very good. I think that's a very good point. And obviously, Texas and Houston in particular have been able to diversify a lot more than what the economy looked like 10 years ago, which is great. To your multiplier effect, yeah, there's a great statistic from the Federal Reserve in Dallas that for every $200,000 job that is lost, it impacts about 4 other positions. So again, getting into your example of somebody who cleans your house or does your yard, or if you go out to eat less, a waiter or a bartender. And if you look at Houston, our jobs were actually slowing last year. So in 2019, Houston jobs grew at 1.6%, which is below our historic average of 2.1. So we were already experiencing some slowdown here. And you said there's some glimmers of positivity, which I want to kind of drill down on a little bit in a minute. But I am curious how many, because energy companies, many of them do tend to carry more debt. How many bankruptcies are you expecting this year?
That's a good question. It's a little bit hard to determine given the mix between private and public companies, but certainly it seems like a lot of the industry has to go away. In the 2016 downturn, if you looked at what happened with the publicly traded companies, almost all the companies, or not all the companies, but a lot of the companies that were in distress at that point in time were able to access the capital markets, both in a little bit in the high yield market, and the equity market was certainly open. If you fast forward to where we are today, you've got the 3 traditional sources of financing that are really not necessarily shut to these companies, but for all intents and purposes, very, very hard to get. You've got high yield financing, which the spreads are totally blowing out. And The smaller companies just don't really have the access to that market. They're not big enough to be able to do a high yield bond in general. You've got bank financing, and the bank financing traditionally has been what's called reserve-based lending, and so they're they're secured by the reserves that the companies have in the ground. Those reserves are worth less today than they were 6 months ago, certainly in the bank's eyes, and in all reality, in economic reality. Um, and if that those lines have been cut. I know there's at least 3 publicly traded companies whose market cap is under $100 million, where their bank lines have been cut enough so that they're in a deficit to that bank line. And when that happens, you typically have 30 days to work that out. The other option that was available to them, and a lot took advantage of in 2016, was the equity market. And today, the valuations are just so low in absolute terms, perhaps not on some of the traditional metrics and multiples, but it's just hard to imagine them coming to the equity market. And frankly, it's hard to imagine the equity market wanting to take more of their paper, especially anybody who bought in that time frame in 2016 isn't going to sit around and be burnt again. I would guess that anywhere from 10 to 20% of the companies will go bankrupt. I've heard estimates as high as 25%. I noticed in the past couple days, we've seen some companies that are trying to make deals with the public bond holders. And so we'll see that might allow them to stave off bankruptcy, but it's definitely going to be a big issue as we get through the next 6 to 9 months.
And I think that kind of underscores why we are either underweight or equal weight the sector at this point. Yeah, it's going to be an interesting period to kind of watch how things materialize. And to get into another crystal ball question, oil was definitely in the news as the last futures contract expired, and you saw oil plummet to negative $35, I think. And that really highlighted some of our supply issues. We've talked about some of the demand issues, and you mentioned we've got problems on the supply side as well. Can you talk about a little bit how long you think it'll take to work through the excess supply and storage?
Certainly. The excess storage situation is kind of grim, especially in the near term. We wouldn't expect the oil price to go negative again. A lot of that had to do with the nature of the contracts and the holder of the contract on the futures exchange, which was an ETF that was invested in oil, and it rolls the futures contracts. And they got into a little bit of difficulty, and there was really some massive short squeeze, if you will, and they had to pay to get out of the contracts, basically. It definitely could happen as the storage shrinks over the next few years, or next few weeks, I should say. It looks like we should run out of storage probably in the end of May timeframe if demand doesn't recover. There's just not that much. I did see a couple interesting facts in the DOE weekly storage report this morning. The build was large. It was over 10 million barrels, but it was less than expectations. Gasoline demand actually ticked up slightly week over week. And also the SPR, which is our strategic petroleum reserve, they increased by 1.2 million barrels. There wasn't any detail in the report about that, but what we think it is the U.S. government is going to rent out the SPR. We've got at least 75 million barrels worth of storage in the SPR, and if they rent that out to private companies, they can make money on the deal, which is a good thing, and it'll exacerbate some of the storage issue, and I think that will help. But I would guess the full excess storage is not going to get down to a normalized level to till late Q3, maybe Q4. But what we will see is the fears of running out of storage alleviating, assuming that we have a June start to returning to a normal level, normal business activity level.
Thank you so much. We also have a lot of clients who have an interest in the Permian Basin for a variety of reasons. And I'm curious what your thoughts are on that particular basin.
Well, it certainly varies to a degree, county by county. You've got the Delaware side, you've got the Midland side, but as a blanket statement, if you're looking across the U.S., it's the most economic basin that we have on the oil side. So at least it's about half the rigs were running in the Permian at the last count, and it's been that way for a while. But if you think about the activity levels and the drop in activity, which has been broad-based, the last 6 weeks the rig count has gone down, which makes perfect sense, relative to where the prices are. What you have seen is other areas such as Oklahoma, which has something, the formation called the scoop and stack. That was popular, and that was pretty hot. And when oil was 60 plus, that's economic for those producers. The Bakken is another area where that's up in North Dakota. There was a lot of rig activity there. And again, at higher prices, a lot of the acreage is profitable. As we've gotten down to the lower prices, and certainly 15 isn't a sustainable low price, the money is going to go to where the best economics are, and the best economics are the Permian. So it will still garner at least 50% of the activity. And as things rebound, it'll be the first place where rigs are added, we think.
Great. One last question for you, and thank you again, is you kind of mentioned a little bit that there's the hopes of light out there, and you talked about the OPEC cuts coming in May. There's so much pessimism on the industry. What are some other things that could go right?
Well, I think the supply side of the situation is being worked out. Assuming the cooperation between OPEC and Russia holds in place, I think you will see the lower price drive the attrition in the rigs in the US and across the world, which will set into motion the declines in that type of production. So I think the supply side is certainly working itself out. And then it just depends on the demand side. And that's just such a big question mark as to, once the world reopens for business, what does demand do? And how does it snap back? Is it a V shape? Is it a U shape? God forbid it's an L shape, because then we're in a lot of trouble. But looking at that's the real question mark. And if you're bullish on the world getting back to normal, and demand getting back to normal, business travel, leisure travel, all coming back. If those came back in Q3, which probably is in nobody's expectations, to snap back to the level it was 6 to 9 months ago, that would be very, very bullish for the complex. So it's, in our mind, it's really all about the demand side right now. And the faster that comes back, and the faster that we are able to live normal lives again, and interact with the rest of the world like we did, a few short months ago, then that paints a very, very good picture for 2021. And you could definitely see a snapback in oil prices.
Thank you so much for your comments. And yeah, I think the trends are going to be really interesting to watch. The world is certainly watching how the next 30 days are going to go. Wanted to thank Bill and thank everybody who had the opportunity to dial in. We always appreciate questions. If you have additional questions, please feel free to reach out to your advisor, and hope everybody has a great week.